Why do we look at the economic calendar? So that we can spot high probability opportunities. Now, here's one in the pound on the Thursday, the 19th of December. What we were looking for here was a vote split from the Bank of England that indicated members of the Monetary Policy Committee were more committed to interest rate cuts moving forward. And we saw the vote split that we wanted. In the cheat sheet here, we just highlighted if we saw a vote split of 3 for a cut, 6 for unchanged, then we're to look for pound dollar sellers at market. You can see here that's exactly what we got with the decision. And if we go and just take a look at the interest rate decision here, we can see here for Thursday, the 19th of December, you can see that vote split came in here. Look, 3 for a cut, right? 6 for unchanged. That was the opportunity we were looking for to sell the pound. You can see the pound dollar fell off very distinctly from that drop. You can see move lower on the spike and then a potential trend line break lower that just carried on throughout the rest of the session. That's why we look at the probability, high probability calendar events, because they provide high probability trading opportunities. So what we're looking for this week, well, the main event to start this week is going to be the UK CPI data on Wednesday. We saw a sharp sell-off in the pound, and the reason for that sell-off was attributed to unusual moves in the UK gilt market, and at first glance it looked like a sign of sovereign distress. In other words, that investors were losing confidence in the UK economy and bond yields were surging as a result of sovereign debt default risk, which caused the pound to sell off fairly strongly, in line with a sell-off in the bond market, pushing UK gilts higher. We also saw dollar strength on President-elect Trump's tariff promises that they were coming and that he was looking at bringing in some emergency legislation to allow the US government to implement those tariffs that President-elect Trump has been threatening. So all of that led to some weakness in the pound last week. And we saw this big move in the UK bond market. You can see here that the move on Wednesday saw a big move in UK 10-year yields, which is the white candlestick chart. And also look at that big move in UK 30-year bond yields, which is the green line. And you can see that UK 30-year bonds is now 5.36%. So that's a pretty healthy premium return for a bond. And you can see here on Thursday that investors have been snapping that up. And this means that there's probably a little bit of stability here for the pound in the near term. And what the analysts at ING are saying is that this move in the UK bond market is not a sign of sovereign distress. In other words, the falls in the pound, they're not likely to continue on this bond market move, and this bond market move should sort of be fading out unless there's another catalyst. And what they cite is the UK's 5-year sovereign credit default swap chart. You can see that that hasn't been spiking higher. So usually that tends to move higher when there's a risk of sovereign default, but it hasn't. So that tells you that it's not a sovereign default risk that's driving that bond market high. Now that's good news for the pound. And the sterling weakness is attributed more to market positioning, that strong dollar theme, that move in the bond market is notable. But what the pound will really need here to be able to sell off sharply is something that allows the Bank of England to definitely start cutting interest rates. You can see they're meeting on the 6th of Feb, and you can see if you look at the terminal rate at the left-hand side, short-term interest market see the UK interest rate being at 4.18%. So in other words, only 50 plus basis points from where it currently is at 4.75%. So that means that, are the Bank of England only going to cut twice this year? That seems, fairly high. But what's stopping the Bank of England clearly signal coming interest rates. I think Bailey was sort of hinting at 4 towards the end of last year. 3 or 4 was making sense to him. But what's stopping the Bank of England, you see, is we haven't had decent UK CPI data moving to the downside. So what are we looking for here? If we see a big miss in UK CPI prints on January the 15th, that will give the pound permission to sell off, right? And that should also impact short-term interest rate markets, that we're more likely to see lower interest rates. So that's the best opportunity to start the week. A big miss in the UK CPI print, then look for pound weakness, and that will either be pound dollar downside or euro pound upside. It will depend on the short-term drivers on the actual morning. Looking at the pound on the CFTC report, you can see it's been steadily sold off, but there still is room for the downside, particularly if there's a disappointing UK CPI print. So that's what we'll definitely be looking at. Will we be interested in going long the pound? No, because we're looking for opportunities to short the pound in line with the recent kind of sentiment and in line with the recent dollar strength. Now, looking later on Wednesday, we've got US CPI data. Now, the latest FOMC minutes, they do see the Fed as starting to slow down interest rate cuts, and they see inflation as being stickier, and that's allowed the Fed to have that higher for longer narrative, which they projected in their latest dot plot. And if you remember, they revised headline inflation higher, core inflation higher, GDP fractionally higher, and they revised up the projections for 2025. So the Fed see that they can take their time in cutting interest rates. So what we're looking for here is either above or below expectations. So if it comes in above expectations, then I look for further dollar strength ahead of President-elect Trump's inauguration on the 20th of January. You could see another boost of dollar strength. That would be probably good for euro dollar downside. And also, if it's a big miss to the downside, then that will contradict some of the latest projections from the Fed, and inflation may be less of a problem, and maybe the Fed can more readily cut interest rates, which would weaken the dollar and should be a great opportunity for euro dollar upside. Definitely worth looking at that CPI print out of the US. Remember, the FOMC minutes, they underscored the Fed's view of solid growth and inflation risks. Okay, so what we're looking for here is out of consensus inflation prints to give us an opportunity in the dollar. Then, of course, we've got UK GDP print. Now, what we're looking for here is any signals that the UK economy is really struggling, that can bring forward the idea of Bank of England interest rate cuts. Now, the Bank of England are really stuck a little bit because services inflation is still high. It's nearly triple the Bank of England's target, so 2%. So how on earth can the Bank of England start cutting interest rates with service inflation so high? Nevertheless, a below consensus print will put the pressure on the Bank of England to cut interest rates. So a lower than expected GDP print should weaken the pound. And remember, Bailey said in December the 4th that he saw 4 rate cuts for this year. And obviously that's more dovish than the current expectations of two and a bit interest rate cuts. So big miss in UK GDP print, then look for pound downside. So they're the top 3 events that I can see for the coming week.